Hello and welcome to episode 241 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leakes. Damien, how you doing?
I'm good, Andy. It's good to be back after our event. Last week we did highlights, didn't we? We did a highlight reel from the event, and this week we are back to normal on the podcast, so it's all good. And also, got an exciting announcement, haven't we?
Yeah, who's doing it?
You are, Andy. Go for it. You can do the...
I'm excited about this too. Okay, so we mentioned last week in the podcast, and it's a promise more than a mention, that we would start up a Facebook community group, because from the event we were speaking to lots of people, and one of the key bits of feedback we got was that people wanted to talk to us, but not only us. What we found from the event, and especially in the pub afterwards, is that people loved chatting to each other. So what better way than creating a community of people? And so that's what we've done through Facebook.
Yeah, so we're doing a Facebook group, which you can all join. The idea is that you go on there. It's not going to be driven by us as such. We're not going to put on topics. You can talk about anything you want on the Facebook group. It can be money. It can be anything else. The idea is going to be like-minded people coming together, somewhere where people can chat openly, freely, without being judged. There's no selling or anything like that going on within the group. It's meant to be people who want to come together and enjoy themselves. So if you want to be part of that group, which of course all of you will want to, then you
get onto Facebook and you must search for Money to the Masses Community. If you search those keywords, Money to the Masses Community, it will come up as a recommended option. Click on there and ask to be part of the group.
Ask to join, and thank you to those of you who applied to be moderators of the group as well. So Lauren chose a number of you. She whittled it down. There's 2 or 3 of you going to be moderators of the group, so you can take control of what's going on and make sure the rules are adhered to within the group. And those who didn't make it as moderators, you're going to be on the list, because as the group grows, it will inevitably do, we will need more and more moderators.
And one of the key things is it doesn't just have to be about money. It's a light-hearted group. It's the ability for lots of people to talk about lots of things. So if you want to chat about, I don't know, ideas for Christmas for your children or anything, football results at the weekend, but obviously it's there for the money people too as well.
Yeah, perfect.
Great. So after that lovely bit of positive news, what have we got actually coming up on the pod this week?
Right, so we've got an investment piece this week based around investment trusts. Now, investment trusts probably don't get enough press coverage because they are a great investment vehicle. They differ from unit trusts in their structure, and that actually lends itself to certain types of investing. And in particular, I'm going to be talking about using investment trusts for income. So building an income portfolio. And I'm going to talk about how you do it and why they make a good vehicle to try and build an investment portfolio. I'm also going to be talking about a scam on Twitter. So I know you love a scam, Andy, but this is one that inadvertently meant that a person lost their life savings and they hadn't even realised it. And it's something that if you ever complained about anything on Twitter, you definitely want to listen to. And the final piece centres around Financial Planning Week. Next week is Financial Planning Week, and it's an initiative whereby you can get a free hour's worth of consultation worth about £500 from a qualified advisor. So I want to talk about that, and then you can choose whether you want to engage with that initiative, but also the sort of benefits and why you might want to.
Great. So what are we going to start with?
And let's start with the investment trust, because it's the meaty piece. Now, this week, 80/20 investor members will know that I spent a long time analysing investment trusts. And over the years, I've produced income heat maps. So when I say heat map, you imagine a grid which has a load of funds listed down one side, and I go back and analyse the payouts, the pound and pence that an income fund pays out in each calendar year. And then I go back and look at how that compares to the previous year. So you can see whether a fund has increased its payout or decreased its payout. Now, I originally did that...
Or if it stayed roughly the same.
Or if it stayed roughly the same. Of course, that's very unlikely. So it's normally going to be up or down. And I've always done that originally. Well, originally I did that with income funds, equity income funds, so unit trusts. They're the most popular type of investment vehicle. And in doing so, the idea was that if you want to build a portfolio that's going to give you a growing income over time, then inevitably you're going to have to focus on equity income funds. And the reason is because equity income funds tend to produce an inflation-beating growth in income over time. By comparison, bonds, they're called fixed interest or fixed income. That's their alternative name. And that's because the payout each year is constant. It's like an interest on a bank account. Think of it like that. So it's the same. And of course, with inflation increasing over time, that's why bonds aren't an attractive proposition when inflation starts to rise, because the amount you're getting paid out in pounds and pence doesn't tend to increase. And so therefore you're losing money in real terms. So the difference is with equities and shares, then that payout tends to increase over time and keep pace with inflation. So I built the heat map so you could look at it in a very quick visual aid. So you could sit there and look at if it was a wash of blue, I use blue to say positive, so the payouts are increasing. You could quickly identify a fund, which there are some that have generally increased their payout year on year, and also looked at the rate of that increase, the percentage increase, and the yields. So over time, people asked me to look at other asset classes. So I recently did it for property funds, I did it for bond funds, and of course, as I said, it did show that bond funds don't tend to increase their payouts all that much. They're fairly constant. But the one thing that was very popular request was for investment trusts. Now, I've now done that, and the heat map was sent out to 80/20 investor members, and I'm particularly pleased with it. I had to go back over 11 years worth of payouts to produce it for a whole host of funds that invest in the UK equity income investment trusts, and ones that are in Asia and globally. Now, the reason why, this is one of the things that is a bit of a learning piece here. Investment trusts lend themselves particularly well to producing an income and a growing income over time. Because what happens if you imagine a unit trust? If you get a unit trust, the manager will invest in a whole host of companies. It could be up to 100 companies, and he'll get the dividends from those stocks in his fund, and he'll use that and he'll make a payout to the holders of his fund. So that payout for that particular fund, which is what I've been analysing. So with a unit trust, they pay out the income that they receive, and they've got to try and pick stocks that are going to grow that dividend, and therefore they can grow their own payout. That's the manager can grow their own payout year on year. With investment trusts, they have the ability to hold back 15% of their gross annual income as reserves. So if you imagine, they might get from an investment trust, they invest in lots of companies as well. They might get an income stream from dividends that come into the investment trust. Therefore, they can hold back some of that for a rainy day, almost like a rainy day fund. So they will decide what the payout will be on the investment trust, and it will go to the people who hold it. But they have the ability to smooth those payouts over time, because by holding back some of the money, if there is a year where, let's say, the assets within the investment trust don't produce the income that they wanted it to, they can take some of that cash buffer, that cash reserve, and top up the payment. And that means they will have a much greater chance of continually increasing their dividend payouts over time. And the other thing that investment trusts have the ability to do, which happened, well, it's come into being since 2012, is they can also dip into the capital value of the investment trust. So that if it's some of the assets that they have within the trust or some of the profits that they've made, and they can use that capital value to pay or top up the payouts from the investment trust. So it is by no coincidence then, when I completed the heat map for investment trusts, that it was a sea of blue. Of course, there were reds in there where people had cut their investment, their payouts. Funnily enough, you mentioned earlier, Andy, about them keeping payouts constant. It's very unusual in the unit trust world because they tend to just pay out what they get in. In the investment trust world, it does occur because they want to at least maintain. They don't want to cut the payouts. Yeah. So it's quite often you'll see investment trusts will have maintained the payout from one year to the next. Exactly.
Yeah, so they may have made a slight loss. They've got that money sort of backed up. They look back at last year and say, well, let's make it at least as good as last year. We'll hope for a good year next year.
Yeah, and in simple terms, that's exactly right, and they can use the methods I've just been talking about. That makes investment trusts very attractive from an income portfolio point of view. And as I said, the research bears out the idea that they are good for income investors. But the other thing that they do is it allows, if you think about it in a roundabout way, the ability to control the income stream, or the income payout I should say, enables them to sort of manage the discount. Now, if you remember, investment trusts can trade at a discount or premium to the net asset value, the NAV they call it. So if you take an investment trust, it's effectively a company, and the assets that it holds, which might be a whole bunch of shares, they may have a market value. The share price can trade at a premium or discount to that net asset value. And that will be, much of that will depend on what people think about the management of the investment trust, for example. And by producing a reliable growing income stream, that makes it more attractive. So what that can happen, if you imagine there's an investment trust that was trading at a big discount, then a fund manager might maintain its income stream. That will make it more attractive to people because they will go, look at that income stream, and therefore they will start to buy it and it will reduce that discount. So that's something to bear in mind. One other thing I would say, so if you listen to that part of the podcast, you think this is magic, because investment trusts are not only going to manage to pay payouts or maintain payouts by using their reserves, or they could dip into capital. There is a slight hitch with the second one of those. Because if you imagine, if we're in a bear market and stock markets are tumbling, if the value of the assets within that investment trust are tumbling away, and they were starting to dip into some of that, then you're going to get into a vicious cycle where they might not be able to maintain that ability to grow the payout. Sense, And of course, the rules that allowed them to do that only came in 2012. And if you think about it, since 2012, we've been in an amazing bull market. So we've not been in a really serious bear market scenario to test what happens to those that have got caught in a cycle. Because not all of them do it. If some that are doing that because they're struggling to maintain their payouts, what will happen if we get into a bear market? That could suddenly have a big unwinding and impact on the fund. So investment trusts, the message is, are very good for building income portfolios and producing a reliable growing income over time, which is important, particularly in retirement. You want an income stream that's going to grow and keep pace with inflation. Now, just an FYI, if you go to the Association of Investment Companies, AIC website, they show details of all the investment trusts out there, and you can filter them and you can see various different numbers, including performance, on their website. One of the interesting things you can see on there is the size of the reserves I talked about. You know, that cash buffer in the background that they keep from good years in terms of income. You can see the size of that. So as an investor, you could look at that and say, well, look at the size. Is that a comfort for the fact that they are going to be able to maintain future payouts? Alongside that, you will see a ratio that will be normally called the reserve cover. I've heard it be mixed up with a dividend cover, but it's a number that you see which will be a measurement of years. So it might, for example, be 0.8 years, which is about an average for the investment trust out there. And that is the number of years worth of payouts that it has in the reserves, if that makes sense. So if it took all of its cash, if it took that and had to use that to pay out an income, how many years worth of income would that produce based on what the trust has been doing? So a typical is 0.8 years. So that means that, a lot of investment trusts have plenty in store. They could maintain the payouts for almost a year, which is good news. So if you see an investment trust that doesn't have a reserve or a significant one, then that might give a hint that if they start to struggle in producing income from the assets, they may be forced to cut the payout. The other thing to have a look at is you can look at the annual statements of these investment trusts, and you will find that there's something called, they call it a dividend cover, but basically you can see the annual earnings versus the dividend that the investment trust pays. So I talked about the reserve, the cash buffer, but what about the actual ability to produce money to pay the income? And you can see that number on there as well. So if this is just an FYI, if you're really into investment trusts or building portfolios, you can find out a bit more by looking at their reports about how they're basically stacked up to meet their future or potential future payouts. So it's just like looking at a company's accounts. That's what we're talking about. So to wrap this up, the heat map that I produced makes it a 2-second job. So you go on there, you can get a free trial of 80/20 investing. You can go and look at all the heat maps I've done over time. So for unit trust, for various different assets that are under unit trust, so equity income, bonds, property, and now the investment trust income heat map. And you can quickly see which funds have produced growing incomes. You can see the year that they cut or the year they kept it the same. You can see the yield. You can see the average increase over the last 3 years as well. So go and have a look if you're interested in building an income portfolio, because this research doesn't exist anywhere else, not to the level that I do, which is why I do it. It takes a very long time. But as a nugget, a takeaway, there are investment trusts out there that have increased their income payouts year on year for as much as half a century, 50 years. That's amazing. There isn't a unit trust that will do that. So that's saying that if you'd been invested in that investment trust and you'd been taking the natural income from it, it would have been higher year on year for 50 years straight. That is some going, and that shows you the power of them. That one in particular, there's a number of them. This isn't a recommendation. This is just a piece of information. The City of London Investment Trust is one of them. And I mean, looking at the data that I analysed, the yield is about 4.48%, and the average increase over the last few years or 3 years has been about 5% a year. So you can see that's more than keeping pace with inflation. So investment trusts, impressive.
Quick question on investment trusts. You mentioned right at the start of the piece that they're not as popular as perhaps they should be. Why is that? Why aren't they? Why isn't everyone talking about them?
One of the reasons that is often cited is because they never paid commission to financial advisors in the past. So if you were a financial advisor in the days when financial advisors were allowed to take commission from the investments that they recommended, they didn't pay commission because they were effectively just shares. So that's one of the reasons why it's always cited they weren't popular. And I think the other element is that they're just not well understood, because once you've been ingrained in unit trusts, investment trusts operate slightly differently. We did a podcast recently over the positives and negatives of unit trust versus investment trust. Investment trusts trade all throughout the day, unit trusts don't. There are nuances, like I said, about the NAVs and the premiums and the discounts. It's just, I think it's different beasts. So people are used to one thing, it's what's in their pension, and they weren't as readily available to buy. So it's only when we had the advent of investment platforms and online brokers that people were comfortable and able to buy investment trusts at an affordable cost. But just like ETFs, their proportion of people's investment portfolios is growing.
Okay, moving on to always my favourite bit. And by favourite, I don't mean that I like it. I just like being able to spread the word and help people out and try and nab those scammers. You mentioned earlier about a Twitter scam that's going on. What is it? What's happened?
So, I mean, have you ever moaned about anybody on Twitter? I'm not talking about people, not the manager of Watford or anything like that. I'm talking about like companies who are giving you bad service.
No, I'm not a big complainer, I must admit, because I just... No.
You're not really a moaner, actually, Andy. I'll give you that. Not in that.
I don't know if you've read my books. That's where I tend to get it all out there.
But what the scam focused on is the tendency, obviously, for people to air their dirty washing in public, but it isn't perhaps I'm being a little unkind there. It's people's frustrations where they take to Twitter to contact, let's say, a bank to ask them a question or air their frustration over a bit of poor service. Okay. And this Twitter scam centres around that. So an example happened to a lady is the first she knew about she'd been scammed is that all her money had been emptied out of her bank accounts. That's the first she knew about anything that happened. When they actually unravelled what had occurred over time is that previously she had complained online about, I think it was a utility bill or something like that. So it was about a utility company. They were unhappy with her broadband or something along those lines. And what happened is if you write to the Twitter handle of the company, you would expect a response. But what happened is she received a response back via a different Twitter handle. But it was, let's just say, I don't want to name any other companies. This is called the company A. Then she got a response from, say, the @customer service company A. It looks kind of legit in some ways, if Twitter can look legit. Because you have to remember that if you go on Twitter, companies have loads of different Twitter handles, don't they? That's the problem. So their customer service people might have a different Twitter handle to the overall brand and all that kind of stuff. And the reason they often do that, they want to keep them separate. Because if you go look at the brand Twitter, you don't want to see all the people complaining at that Twitter handle.
Yeah, so they're kind of moving those sort of complaints and everything else over to a different thing, and that can be centralised and managed, Yeah,
so what happened, she received this from somebody who said, look, I've got your complaint, and they entered into a dialogue. And she took photos of it as evidence that, I'm having this dialogue, so when the complaint wasn't resolved, she could go back to it. Of course, in hindsight, there was no point doing that because clearly this person doing this was a fraudster. So what they did is they started asking her about, okay, in order to resolve your complaint, I need to know your account number and your name. And of course, they started to ask for other slightly more sensitive details like her date of birth, and then obviously needed her bank account that the money was being paid from and be able to get those details. In a roundabout way, what they did was get key bits of information from her by pretending to be the Twitter handle from a company, which anybody can set up a Twitter handle. That's the problem with social media, and it's one that's been a complaint of a lot of famous people actually who are getting trolled online, that there is no real verification of who people are when they take out social media accounts, particularly on Twitter. So you can go on there and pretend to be anybody. There's no evidence that you have to prove you are the person you say you are. I'm ignoring the verified blue ticks, but don't forget that Twitter has stopped giving those out anyway, so not even that is a way to verify that the Twitter handle is actually genuine. So the fraudster in this case, the lady was unaware, had got some key details. Presumably what they then did was go to the bank that she banked with and gain access to her accounts, probably over the phone, because they had all the key information that they'd asked for, etc. They then proceeded to empty her accounts. And of course for her, this became a bit of a nightmare to try and resolve, because obviously, as you know, a lot of banks will start to pin the blame on various different people. So the moral of the story is, be careful when you're dealing with anybody on Twitter. You want to take everything very quickly to a secure place, because if you air any grievance in public or you give away any information, for example, when people always write on social media that it's their birthday, it's my birthday today, I'm 41 today, then you've told the person your exact date of birth and they probably already know your name. So you have to be careful of stuff like that. So that information, people start using that, they're pretending to be people who they're not, companies who they're not, getting information, and once they've got that, it's no different to the old days when people used to go through your bins to get the information from bills, etc. They can then use that and then take your money, and you've become a victim of identity theft.
Okay, so we're going to move on to the last piece, Financial Planning Week. It's an initiative from the 7th to the 11th of October. You're going to tell us some more.
Yeah, it's by the Chartered Institute of Securities and Investments. So it's CISI. And
that sounds like one of those programs that my wife watches. I don't know.
We won't talk about the programs your wife watches, Andy. Financial Planning Week is an initiative to encourage people to engage with financial planning. And what happens is, once a year, they get a particular week, and it is next week, so the week of the 7th to the 11th of October. You can go online, go to their website. So if you Google Financial Planning Week, I won't read out the web address, because unfortunately the web address they've got is quite convoluted. I don't know why, but we've written an article about it. I say we have, Andy has, which is going to be online. So Andy will put the link in the notes of this podcast, and also we can now say in the Facebook group there will be a link to the
in the community group. Yeah, we'll do that
in the article there. Like I say, Andy and I will post in there, obviously. From time to time, we are members of the group as well, but we will put that in there amongst your discussions, and you can then find a link to it. But what happens is, you can find a certified financial planner who is taking part in Financial Planning Week, which means that they will give up the hour of their time for you to have this conversation and meeting. So get involved. The reason why you might want to is because you might not know if you need advice, or you might have something you want to particularly talk about. There was a point at last week's event that I sort of talked about briefly, but it was that reverse engineering idea. If you've got your dream, what you want to try and achieve, then you need to sometimes reverse engineer that. That's what financial planning really is. And what happens is, people don't even think about what it is they want, what their retirement, for example, might look like, and then be able to work backwards. And therefore, they don't even start a pension. Equally, you have people who just pay into a pension and don't really know what the end goal is. And so they have a pension but not a plan, which is equally something that you need to resolve, because you might be paying to a pension and you might be not have a plan what your life's going to be. You might decide you're going to continue to work or start a new business, or you might want to retire early. You need to make sure you know what the plan is so you can work back and reverse engineer that to know that what you're going to be paying into your pension. And if you can't do that yourself, which a lot of people won't be able to, then you can go and have a look at our calculator, our pension calculator, which you can find on the website. But do look at this idea of financial planning, free Financial Planning Week. If you're listening to this podcast, well, today, i.e. timely, or in the future, if you go onto the Money to the Masses website and search for Do You Need Advice, you can go through and find on there something that's done for us and vouched for, where you can get a free 30 to 60 minute call to go through your sort of basically a financial health check, as it were, regarding pensions. It's like a with an advisor, so it's very similar to what this Financial Planning Week is doing, but it's ongoing. So if you miss Financial Planning Week, don't worry. go and look at Do You Need Advice on Money to the Masses website. You'll find that article. In that article, you'll find a link through to Vouch For where you can find a very similar offer that's ongoing. So do take advantage. It's one of those things that if you go and have a look at it, have a conversation, it won't cost you anything, and you can find out whether you need advice or not. Oh, and one final piece I want to chuck out there, just a quick tip. This week, if you've ever heard of WASPE, it was the Women Against the State Pension Increase. What happened when state pensions were equalised for women, there were a whole load of women, when I say a load, we're talking I think about 2 million, who weren't told about the fact their state pension was going to increase. They weren't sent communication. And it wasn't that anybody was, the government just didn't. Obviously the government is prone to making changes. The government doesn't tell you about these things. The onus is always on you to basically find out. And of course, a lot of women got to the point they thought they were going to get their state pension and they didn't, and now they've been in financial hardship and they've been wanting to be reimbursed, as it were. So they basically want to be put back to where they would have been. And of course, this has been to and fro in. There was a case brought into the courts this week that was a ruling on, for sort of once and for all, whether they were discriminated against, and it was ruled that they weren't. So unfortunately for these women, there was going to be no kind of change or financial reimbursement, as it were, as a result of those changes. The message, what I want to get out there, is make sure you check your own state pension age, that you know when you're going to get your state pension. And also you can get a state pension forecast, so you can see how much you're going to get, because don't assume you're going to get the same as your neighbour or anybody else you know, because it's dependent on your national insurance contribution record. So if you go to the gov.uk/check-state-pension, then there is a nifty tool which you just click through and you can then get a state pension forecast for yourself.
And it's important to know that if you are falling short of your state pension, where you thought you might be because of your national insurance contributions, you can top those up, can't you? We've got an article on the website that explains how to do that.
Yeah, and the reason why this is linked to the Financial Planning Week piece is because it should spur people on to suddenly realise, oh, I need to get advice, I don't know what my options are, I'm going to have a shortfall. And so it's about stop burying your head in the sand, just taking a step, taking some action, and then you can talk to somebody and you'll feel a lot better about it, because you'll then start to have a plan.
Do you know what? And that's really timely, because my wife and I have been talking about topping up our life insurance, critical illness cover. We've got 2 young girls, and we've known for a long, long time that we've needed extra cover. And it's one of those things, you just bury your head in the sand. But anyway, the final inspiration for us is that my wife was turning another birthday, and it would have meant that the policy would have gone up in price. So we went and did it. So I feel amazing because of that. And that's kind of the
message. And the feel-good factor that comes from ticking a small thing off your to-do list is what the money MOT was built on. So my money MOT, go and find Damien's money MOT. You can just search that word, actually, and you'll find it on Google. Do the money MOT, because that's what it was all about. If you go through it, it's very quick. It takes you 2 minutes. At the event, loads of people did it live while we were there. You can choose to get an action plan that will help you take you through these steps. It's literally, boom, this is what you need to do. Do this, look at this, and takes you through step by step in very small bite-sized chunks at your own pace to help you be able to move things forward.
And if you do that action plan and you do sign up for it, just a little tip, you may well save money by doing so, because I've done exactly that recently, and it reminded me I needed to do my will. I can't believe I'm admitting this on the podcast, but I still haven't done my will. But by doing it through Damien's Money MOT, I managed to save some money on my will as well.
Yeah, so. and a nice circular mention of this. So we've gone full circle. You'd think these podcasts were planned, wouldn't you? That one of our moderators of our new Facebook group, Neil, even shared the fact that when he did the Money MOT, he saved, I can't remember, you can find how many £100 he saved
a good couple
on
of
his bills.
£100, wasn't it?
So fantastic. That's it for this week, Andy. We're done.
Good. So if you want to get in touch with Damien, you can do so. It's Damien at moneytothemasses.com. Twitter, it's at moneytothemasses. And number 2, we're on Instagram as well. Get over to YouTube. There's lots and lots of stuff going over on YouTube. 3 or so videos a week going live on there. And of course, we mentioned earlier, the Facebook community group. Search for Money to the Masses Community. You search for those 4 keywords, it will come up, and you'll be in there. And we'll be able to chat to other like-minded people.
Until next week, Andy.
Yeah, see you later.